Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 18 weeks ago, I highlighted a bright pink July 24 to date rectangle pattern, currently 957 to 1099. This pattern is still operational even now. The top side for this pattern is also capped by the nearby 50% Fibonacci line of the May to August 2024 move, also at 1098, and the 61.8% absolute Fibonacci line at 1106. Nearer term, the market over late April and early May had tried to stabilize over the November 2020 low at 1045 and looked for a while like it might try higher. But over mid-May and then mid-June, we could see a capping action. Now that's symbolized by the bright red, fairly flattish upper trend line on my daily chart, currently at 1083. At the same time, the basis of the recent actions since April also lined up into a lower trend line, currently bright red lower trend line, currently at 1012. Together they made up a proposed expanding wedge pattern that this week breached on the downside. This is the immediate pattern to look at right now. So whilst it is a bit early, I still thought it appropriate to set up some potential targets below for the bright red expanding wedge pattern. And we could be a false break, but let's try this. Thus the primary target X would be in the 991 zone, and that's tying in with the lows of March and April, whilst a secondary, harder to achieve target X1 would be down in the 944 zone, and that's tying in with the September 2020 low at 942 and the August last year low at 940. Now, I would also keep a wary eye on the somewhat flatlining long moving average, and that's currently at 1030. This had been penetrated 2 weeks ago, but proved to be a base of support for the subsequent move back up later on last week. However, we have turned lower with a shooting star pattern late last week, the bearish variety, and we've seen since prices punched down through the long moving average with some ease, likely helped by the monthly key reversal down seen in June, down to new lows not seen since early April. As a byline, we also had a monthly key reversal up this time in Chicago soybean oil, which I will detail later on this video commentary. And I'll leave it to you to ponder on the imagery of one part of the soybean complex here making a monthly key reversal down, whilst another, soybean oil, making a monthly key reversal up at the same time. Now a further feature which I had highlighted before on my daily chart, and which is also important, is the dark blue late December 24 to early April 25 bullish shift pitch hawk. Yesterday prices punched down and closed below the lower time for the first time, and that's currently at 1017. Such a move has signaled that I might have to retire this shallower bullish pitchfork at some point in the not too distant future. 13 weeks ago, I linked some of the recent highs into a bright red downtrend, and are currently at 289.70, that tied in nicely back then for a while with what was the descending long moving average, currently 301.30, that was then just about shadowing the downtrend but a little higher up. And with the medium moving average currently at 296.20, which earlier had failed to produce much resistance above, but then energized itself as a resistance, and quite a good one, over mid-May to mid-June. Now, 7 weeks ago we had a clear close over the bright red downtrend, and prices tried to stabilize over this breached, possibly broken downtrend. However, the bears out there really relied on the overhead medium moving average to cap the market's rise, and so it did. This breach on the upside was just a breach and not a break higher, as I was not impressed with the show of any significant bullish incentive there. This all impinged on my thoughts from 15 weeks ago as to whether the whole action this year had developed into a type of descending triangle pattern, morphing into a descending wedge pattern, with the bright red downtrend topside being the upper trend line and the 290 level below being the base for the, well, it was then below, for the descending triangle, and also importantly the early January to date purple lower trend line, currently at 283.40, being the lower trend line for the descending wedge pattern. I said 5 weeks ago, and I quote, For the future, I think a lot will depend on any move down below 290 to verify if it will be a descending triangle or a descending wedge pattern, or on any true break above the seemingly resilient overhead medium moving average, and ideally over the long moving average just above that for any significant move higher. End of quote. I also add that my major concern is the same as it's been now for 15 weeks here, and that is, as I warned back then and since, and I quote again, a possible false break here out of this proposed descending triangle pattern. End of quote. 3 weeks ago, prices broke down through the 290 zone, the lower support for a descending triangle pattern, and 2 weeks ago they broke down through the purple lower trend line for the descending wedge pattern. The market has now seemingly stabilized below this latter one, and it was enough last week for me to set up some potential possible targets below for both patterns. Thus, for a descending triangle pattern, we had a primary target down in the 273.20 zone, with a secondary harder to reach target X down at 255.60. For the descending wedge pattern, we had a primary target down in the 272.30 zone, with a harder to reach secondary target X1 down in the 242.80 zone. As you can see, we've already reached both primary targets for the descending triangle pattern and the descending wedge pattern as well, just leaving the harder, in some cases much harder to reach, secondary targets further down. This leads to last week's action, which has seen a somewhat reactionary move back up from earlier lows. It prompted the question as to whether this break lower was yet another false break, but this time on the downside, and that such an action is something we see on occasion on breaks lower to descending wedge patterns, which is a dip that swiftly reverts higher and maybe starts a new bullish move. Now, this has not been such a dip, just an aberration on the upside, and prices have continued this week lower, gapping lower to lows not seen since April 2016. Indeed, today challenging the April 2016 low at 268.60. Thus, for now, I will continue with targets X and X1 below. Finally, this commentary would not be complete without my discussing the elephant in the room, or at least the elephant in the room which has stayed there in the room throughout 2024 and also resonates now into 2025, and that is the annual key reversal seen here at the end of 2023. I said, and I'm afraid I have to repeat something I've now highlighted for 109 weeks, yes, a full 2 years, and I quote, "I now only need to remind you once again of my words when I pointed out the Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we have been living in the shadow of this pattern ever since." End of quote. I've also added ever since, and I quote, "There's only one thing you take away from my musings. Let it have been those words." End of quote. These last few weeks have shown that the shadow cast by that supremely significant pattern so long ago still darkens the skyline of this market. Chicago soybean oil. 3 weeks ago, we had a gapping move higher that punched up and out of the earlier showrunner here, the shallow bullish shift pitch hook for the mid-September to late December 24 move. 2 weeks ago, we stabilized over the upper time, which is currently at 51.86, and last week prices pushed higher over the 50% Fibonacci line of the March 20 to April 22 move at 56.34 for a small gapping move higher, though this week we have been giving back some of those gains with a smaller high than the one in June, and now either side of the 50% Fibonacci line today at 53.59. This 50% Fibonacci line is quite interesting, as it is the gateway to overhead congestion that stretches from 56.34 till at least the top of my daily chart in the 59.44 area. All this action caused a monthly key reversal up here for June, and I have earlier in my soybeans commentary today and last week also mentioned the imagery we have with a monthly key reversal up here in June having a monthly key reversal down in the soybean futures contract, all at the same time. This leads me to what may be the more dominant pattern here, and one I mentioned 5 weeks ago. It was, and I said at the time, and I quote, a new pattern emerging over the last month or so, and one that I warned may kick off 2 weeks ago. So that's actually now 6 weeks ago, and has actually done so since, though the break has not fully stabilized as yet. It is a dark blue start of April to end of May ascending wedge pattern, currently 50 even to 57.34, and that's the end of the quote. This pattern has the requisite number of touches on each side, and late 6 weeks ago had a brilliant breach and break lower, but as I said 5 weeks ago, and I quote, clear consecutive closes below this dark blue lower trend line and I would feel obliged to lay out potentials and even possible targets below for this pattern, something I'm not confident in doing just yet, as I fear a possible false break lower. I can only emphasize something I said only 2 weeks ago, so that's now 8 weeks ago, and that was, and I quote, it wouldn't surprise me to see some sell stops situated a short distance below this 38.2% Fibonacci line. I think today we have seen those sell stops being triggered once again, end of quote. Well, 5 weeks ago I felt obliged to lay out some targets below for this pattern. Arguably the market reached a pretty easy primary target down at 46.03, but I also added a secondary hard to reach target down at 45.03 at the 2014 low below, and a tertiary much harder to reach target down at 43.74, at where the 50% absolute Fibonacci line resides. These were quite big targets to achieve on the downside, and I mentioned at the time that they started to seem, well, unlikely. I have since retired them in light of the action at the dark blue ascending expanding wedge pattern. Now the only other feature I'd form is a new lower trend line to the ascending expanding wedge pattern, and that's currently at 47.04. I have not fully explored this idea, but I feel obliged to lodge it in your mind just in case.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.